You did everything they told you to do. You opened an account, you watched the ticker, you bought what was hot, and you told yourself this time it would work until your portfolio bled red for months. And here is the part nobody wants to say out loud. The reason retail investors lose money in stock markets is not because you are unlucky. It is because the game is built for someone else to win, and the rules of that game match how institutions operate with money, time, and information. This is not financial advice. This is financial education, based on how markets actually function and how large players can and do operate. In 2026, this lesson matters more than ever because the same forces that crushed your purchasing power with inflation and inflated housing prices beyond wages are now showing up in investing too. While you are being told to learn to code to survive AI disruption, the people funding AI infrastructure, data centers, and trading systems are also compounding their advantages. And while you are told to be patient for retirement, your savings are being chipped away by the real cost of living and the delayed relief that never fully arrives. So today you are going to understand why individual investors consistently struggle. Not in a vague way, in a mechanical way. You will learn how capital size, execution speed, trading behavior, and market psychology combine into losses that look like your mistakes, but often function like their playbook. First, let's start with the most boring truth, and the most brutal one. Money size changes everything about what is possible in the market. In the real world, capital is not just more resources. It is leverage over liquidity, over timing, and over price itself. When you are a retail investor, your account might be a few tens of thousands of dollars. When you are an institution, your account might be hundreds of millions or tens of billions. That difference is not cosmetic. It changes how markets absorb your orders. It changes how quickly you can enter and exit. It changes what you can afford to ignore. Imagine a large asset manager with access to billions. If they decide to buy a stock that they expect to move, they can buy it in size while the market is temporarily illiquid, pushing the price toward their target. They can do it across multiple venues, across multiple time windows, and with internal execution strategies designed to minimize slippage. Meanwhile, you are staring at a limit order screen, trying to get the price they got, and missing it by the time your order fills. This is why retail traders feel like they are always late. It is not paranoia, it is structure. Institutions can move first, test with smaller slices, and then commit when they know how the market will react. They can also reverse quickly. They do not need to wait for everyone else to agree with them. They can shape the path while you are forced to react to the path that is already underway. And in 2026, structure matters even more, because volatility is not just driven by economics anymore. It is driven by technology, algorithmic trading, high-frequency execution, and the increasing automation of strategy selection mean that small orders can be treated like noise. Your buy is not information, it is often just volume. Now connect that to what you have lived through. You watched inflation come down on paper, but your real purchasing power did not bounce back. You watched interest rates get adjusted by the Fed, and you still felt it in mortgage rates, in credit card APR, in the cost of groceries that never fully returned to what they used to be. Your salary did not move fast enough to outrun the cost of essentials, so you looked for growth. You looked at stocks because stocks were supposed to be the ladder out. But if the ladder is steep and the person holding the rung has your weight in mind, you will slide. And here is the part that turns your frustration into anger. The mismatch between your scale and their scale is not an accident, it is business design. Retail investors also suffer another quiet disadvantage. You are forced to work with the time horizon of your paycheck. Institutions can commit over months or even years because they can afford to hold through uncertainty and because their compensation models often reward consistent risk management rather than getting it right this week. You are trying to make decisions while still paying bills, while watching AI layoffs, while trying to figure out if your role will be automated next. Institutions can research for weeks, model scenarios, study earnings and guidance, and cross-check industries with thousands of data points. They can monitor technical levels without panic because they understand how probability works across cycles. You, on the other hand, see a red candle on a Tuesday and decide your fate by Friday. Pattern interrupt for a moment. Think about a nurse or a truck driver or a junior analyst who just got hit by a pay cut or hours reduction. That person is not just trading stocks, they are also managing rent, childcare, medical bills, and the growing fear that AI will replace their job before their next raise arrives. When you are under that kind of pressure, you do not trade with calm. You trade with urgency, and urgency is exactly what sophisticated players can price in. They know that retail investors chase momentum. They know you buy when prices rise, and you sell when prices fall, and that behavior creates predictable demand waves. They know you will panic when the news headline hits, and they know you will rationalize your losses when the original thesis is already broken. So they do not need conspiracy, they just need human nature. Now we are going to get more specific, because human nature is too general. The real mechanism is that your trading style is often the opposite of what institutions are optimized for. Institutions tend to concentrate. They pick one or two names, allocate meaningful capital, and invest time into those positions. They can build a thesis and then execute it with discipline. When they move, it is not random buying and selling. It is planned positioning, and planned positioning can create the impression of inevitability. Retail investors tend to spread. You diversify across dozens or hundreds of tickers because it feels safer, but diversification across too many positions often turns into diluted conviction. It becomes a portfolio of maybes, and in practice, it means you cannot properly monitor each company's fundamentals, risk, and valuation. You cannot respond intelligently to what changes. You cannot develop the deep familiarity that lets you hold through drawdowns. So what happens when the market turns? You sell something, you hope something else recovers, and you keep cycling through decisions that are driven by emotions rather than rules. You end up with returns that look like randomness. You call it volatility. Institutions call it retail flow. And here is where it connects to 2026. Your real world already punishes dispersion. Housing costs keep rising while wages lag. Energy and insurance costs get hammered by climate risk. In many places, people now pay higher premiums because the insurance markets have gotten tighter after extreme weather. That means your budget is not flexible. Your survival margin is thin. When survival margin is thin, you cannot afford to make slow, rational decisions. You make reactive decisions. And reactive decisions are exactly what trading systems are designed to anticipate. Now, the fourth disadvantage is where things get truly ugly. Institutions can control price movement more effectively because they can choose when to hit the market with size, and you cannot. If an institution wants to accelerate demand for a stock, it can buy in a way that increases visible momentum and attracts other participants. It can also increase volatility intentionally by coordinating execution patterns. When the institution wants liquidity to appear, it can provide it. When it wants liquidity to vanish, it can withdraw. You can't do that. You are one order in a sea of orders. You are not moving the tide. You are getting carried by it. And this is why retail investors often experience a pattern that feels personal. You buy, it drops. You hold, it drops more. You buy again because you think you are averaging down, and then the stock rebounds for a brief moment, just long enough for you to believe you were right. Then it falls again, and you are trapped watching red. Institutions understand that this sequence can be psychologically sticky. They also understand something else. Retail traders are not just reacting to price, they are reacting to being wrong. Losses are identity pain. People will defend their choices to protect their ego. So institutions benefit from the fact that you will often delay the decision that would limit harm. Now let's talk about knowledge. The internet will tell you that retail investors lose because they don't understand markets. That part is true, but incomplete. The deeper truth is that retail investors often refuse to learn the right discipline because the system teaches you the wrong incentives. You learn about charts because charts are visual and easy to share on social media. You learn about signal because you want certainty. You learn about breakouts because it feels like a path to quick wins. Meanwhile, institutions spend time on fundamentals, scenario analysis, valuation frameworks, and risk controls, and then they overlay market timing using technical levels that match their thesis. You might think you are being careful by studying charts, but if you do not understand what drives the cash flows, you are trading patterns without owning the business logic. You are playing a shadow game. And here is a pattern interrupt that matters in 2026. AI has changed the speed at which information reaches you, but it has not changed the underlying disadvantage of retail. In fact, AI makes it worse, because synthetic hype can spread faster than real analysis. You can now get automated newsletters, automated social posts, automated analysis that is generated to sound convincing, and automated trading that follows sentiment rather than fundamentals. So you are not only competing against institutions. You are competing against institutions with AI, and competing against AI-boosted retail misinformation. Now we are going to build the next bridge, because it is not just about how you trade, it is also about what you trade. Many retail investors chase what is hot. They buy high because they fear missing out. They sell low because they fear being the last one holding the bag. That behavior is predictable, and predictability can be exploited. Institutions often prefer less crowded positions. They buy when attention is low, when valuation might be misread, or when sellers are weak. Then they work the stock through cycles, using their control of timing and liquidity to shape price movement. You see this and think, how did they get in so cheap? You imagine it is insider trading. Often it is not even that dramatic. It is simply that you did not look far enough back, and you bought based on emotions that were already reflected in the price. In 2026, you also see this in another form outside stocks: passive income scams, creator economy fantasies, people selling a lifestyle on social media while most creators earn nothing. The same psychological trap is used. Show the peak, hide the path. Show the final screenshot, hide the time spent failing. Stocks do the same thing. They show you what looks like the summit, and they hide the drawdown on the way up. Retail investors interpret the screenshot as proof that the system works, not as proof that the system selects who survives. And now remember the nurse we should talk about. Picture a 32-year-old nurse named David. He lives in a town where rent jumped again. He works nights. He has student debt. He keeps hearing that AI will change healthcare workflows, and he feels like the ground is moving under him. In 2024, when he heard that markets always recover, he started investing a chunk of his paycheck into a tech stock that everyone online was posting about. He bought after a big run because it felt safer than buying something boring. For weeks, it rose. David convinced himself he was finally on the right side of history. Then earnings came, guidance disappointed, and the stock dropped hard. He told himself it would rebound because he saw analysts on social media repeating optimism. 2 weeks later, it dropped again. David held because selling felt like admitting he made a mistake. Now here is where institutions understand human weakness. They understand how long you will rationalize before you admit reality. They understand that retail investors often refuse to cut losses because they think cutting losses is giving up. In reality, cutting losses is accepting a controlled truth. You were wrong about one variable, and you protect the capital that allows you to be right later. David did not cut the loss. He did not set a rule. He watched, he hoped, and eventually he sold, but not because he made a logical decision. He sold because he needed cash to cover a medical bill. So his trading wasn't just a financial event, it was a forced liquidity event. The market used his life against him. We will come back to David because his story ends in a way that explains why this is happening across markets. But first, we need to explain the most overlooked reason retail loses: the absence of a system. Most individual investors do not have predefined rules for when they enter, when they exit, how they cut losses, and what risk they accept relative to their total capital. Without those rules, you don't trade. You react. And reacting is what the market counts on. Institutions often have systematic processes, not perfect ones. Systematic ones. They know their risk tolerances. They know the maximum drawdown they can survive. They know when a thesis is invalid. They know what to do if volatility spikes. Retail investors often do the opposite. They increase position size after losses. They average down without a valuation framework. They decide based on the feeling that the market owes them a recovery. But markets do not owe you anything. Markets price the present and the future. And if you buy an asset at the wrong price, you can be right on the company and still lose money for a long time. Institutions understand this. Retail investors confuse being right eventually with being profitable now. That confusion is deadly when you combine it with another big mistake: too much trading. Retail investors often trade frequently because they are restless. They want to feel like they are doing something. They want the dopamine hit of action. But trading frequently increases transaction costs, increases taxes in taxable accounts, and increases the chance that you will act during emotionally intense moments. In 2026, this becomes even more damaging because inflation has taught many people that cash is fragile. And when cash is fragile, trading mistakes are amplified. You do not have enough buffer to survive repeated errors. So what do? You spiral. You chase returns. You buy higher. You sell lower. You call it learning. Sometimes it is learning. Often it is just the market extracting tuition from you over and over. Now I want you to notice something. The original promise of retail investing was that it democratized access, that anyone could invest, anyone could grow wealth, anyone could beat the system. But if democratization is true, why does the outcome remain so lopsided? Why do retail investors consistently underperform? Why does the stock market feel like a place where the winners are always the ones with deeper pockets? The answer is not that you are the problem because you are dumb. The answer is that you are the problem because you are predictable. They already know how you behave. And in 2026, your behavior is being tracked across platforms, across devices, across trading apps. Institutions don't need to guess. They correlate retail interest, social media sentiment, and order flow with price behavior. That means the market is not just an open auction, it is also a behavioral battleground. Now let's connect it to 2026 retirement and housing, because this is where the emotional pressure becomes real. You are not investing in a vacuum. If you are in the United States, Canada, the United Kingdom, Australia, anywhere wealth has been concentrated and housing has detached from wages, you are probably watching your options shrink. People who bought homes in 2019 did better than people who tried later. People who bought in 2020 through 2022 are experiencing a different kind of pain as rates reset and mortgage costs adjust. People who tried to rent are trapped by rent increases and the fact that wages did not rise enough to keep up. When your housing costs rise faster than your income, you need returns faster. You start expecting that a stock portfolio will fill the gap. That creates a dangerous feedback loop. The more you need the portfolio to work, the less patient you become. The less patient you are, the more you trade emotionally, and the more you trade emotionally, the more you lose to players who are disciplined and properly capitalized. So you are not just losing money, you are being pushed into the behaviors that lead to more losses. Now, crypto is another example, and it makes the same point. The promise of decentralized finance was freedom from institutions. But in 2026, regulation has hardened and institutional ownership has surged. Many people who bought crypto to escape bank control ended up in a market where the liquidity, custody, and large positions are held by players with infrastructure and scale. Retail often sees volatility and thinks it is a chance to get rich. Institutions see volatility and see risk premia to harvest. Stock markets are the same story with different branding. Retail is offered access but not equal power. And now we are ready to go back to David because his ending is where the lesson becomes painful. After David repeatedly averaged down and held through declines, he eventually decided to leave trading alone for a while.